Hey guys, welcome to the Silver Report. Here we are. It's Monday, February 20th, 2017, and let's get right into some of the economic factors that will be playing a part. And we have these Federal Reserve talking heads coming out and discussing how we should see an interest rate hike in March. Of course, that's why they're flooding the news streams with this, because they know they can't do it, because number one, when interest rates rise, bonds lose their value, and they're holding significant number of bonds. Perhaps the biggest risk facing investors this year and beyond is whether bond yields will suffer a sustained rise. We are increasingly worried that the bond market is undergoing a secular pivot from bullish to bearish, and that investors are facing an asymmetric risk profile with limited upside and plenty of downside. And so the reason this matters so much right now is because during the economic crisis, much of the money was moved into the bond market because the stock market was suffering major losses. And these bonds are beginning to mature. And what we're seeing is that there's not going to be return. And the Federal Reserve, who's also holding, for example, we took a sip of the quantitative easing juice and we loved it. Now we're full. The game has changed. The Fed assets worth $858 billion on its books in the week ending in 2007, August 1st, just before the start of the financial crisis. The same stood at $2.24 trillion at the end of 2009. Right now it's at $4.5 trillion today. The Fed printed and bought $1.7 trillion in mortgage bonds. They bought government bonds. Slowdown, taper, reverse. I believe we're facing a secular pivot in bonds after 35 years of one of the greatest bull markets that sent rates from mid-teens to near zero. It's endgame. I'm pretty sure more than a few investors are unaware of the risk that this poses. Inflation eats into returns. And who wants to buy from your client that 2.4% yielding piece of paper when they can get 4%, 5%, 6%? Speaking of 6%, it just might be here in a few short years. Now, what we've seen is almost a decade after it all began, the Federal Reserve is finally talking about unwinding its grand experiment in monetary policy. And when this happens, the knock-on effects in the bond market could pose a threat to the U.S. housing recovery. The talk has prompted some of Wall Street to suggest the Fed will start its drawdown as soon as this year. It's going to refocus attention on its $1.75 trillion stash of mortgage-backed securities. The Fed owns treasuries as part of the $4.45 trillion of assets. Its MBS holdings have long been a contentious issue, with some lawmakers criticizing the investments as beyond what's needed to achieve the central bank's mandate, and who said its mandate is really to manipulate the economy and investors. Yet because the Fed is now the biggest source of demand that we have in the whole world for U.S. government-backed mortgage debt and owns a third of the market, any move is likely to boost costs for home buyers, which you already are seeing inflated prices rising right now. In the past year alone, the Fed bought $387 billion of mortgage bonds just to maintain its holdings. Getting out of the bond buying business as the economy strengthens, it could help lift 30-year mortgage rates past 6% within 3 years. And so, what we're seeing, the bottom line for bond investors is this: when interest rates rise, bonds lose value. And so, this is a very dangerous effect. And besides all this, so much money was put into the bond market. So much of the wealth of this country, and we're going to see losses, massive losses of wealth. As for equities, the number one rule many of us were taught is don't fight the Fed. And so you should add trend into that equation. And you'll see when the Fed raises rates and the trend turns negative, equities underperform. So 2 different time periods are measured, however, the message is the same. The big corrections come when both the Fed and trend turn negative. And so what we are facing, number one, they can't raise interest rates. They can't raise interest rates. It's a very serious issue that we are facing in the bond market when an interest rate hike comes, but also we are being pressed between a rock and a hard place as we see that we are facing inflation coming. We have seen within recent weeks and months the rise of heating fuel, the rise of gasoline, of bread, milk, grain. And we're also facing many new dynamic shifts in the economy. We have a new administration stepping into office. We also have had fabricated numbers. We've had fabricated employment numbers. And we've had wage stagnation. So when we have inflation with wage stagnation, on top of that, a broke Social Security, what we're finding is that the American people, the American citizens, do not have enough money to keep up. Add onto that the tensions among the US dollar. What we are facing is a rise in the price of silver due to inflation. Inflation is unable to be stopped. The Fed's 2% inflation target, it was achieved in January, and it continues to be high, both here and in Europe. Janet Yellen's unemployment target, I don't know what her target really is, what her plan really is. She said this week's the Fed's main tool for setting monetary policy will remain the Fed funds rate. And they said they're not going to shrink their $4.5 billion balance sheet until they begin the interest rate hike. And so what we're going to see is a spike in housing. And we already are seeing a rise in bankruptcies for individuals and for companies. We're already seeing a rise in defaults in the credit market. We have a massive credit bubble that is formed. We have defaults on consumer credit, on auto loans, student loans, mortgages. And so these defaults, pressed with the pressure of raising the mortgage rates, on top of their unemployment goal being met by the employees that were added on for the housing sector, in particular real estate agents, lenders, new housing construction workers, contractors. So on top of this, these pressures are going to wipe out any advancement that has been made in the economy, further unraveling their imaginary, I guess it's their goal. But the fact is, they're not being honest. They're not saying all the truth, that this economy can't even recover. And what we're facing is one of the most dangerous times that has been known in recent history, which is why it's time not only to buy silver, but to buy food, buy water, stock up, and hedge against this coming credit collapse that will be invoked if the Fed raises interest rates. These defaults will accelerate to the point where these massive institutions will fail once again. And because of the mandate put into the Dodd-Frank rule that was not removed, they now have the right to liquidate your savings as their own personal debt. So beware, because the day is coming. And when it all falls apart, too many will be rushing to try to find some way to save themselves, which is why it's good to buy now when the levels are low. All right, thank you guys for joining me here on the Silver Report. If you like the content, be sure to subscribe, like the videos, share the videos. I thank you guys all so much for stopping by, and as always, stay safe.